Hello, and welcome to another edition of Econ Updates. I'm Steve Taddie, Chief Economist with Hoyle Cohen Wealth Management. Now, the purpose of these updates is to give a little insight about economic activity and talk about how those activities affect the markets. So with that, let's dig in. Economic growth, the outlook for 2024 is fairly decent. Positive economic growth, a little bit behind 2023 levels, and a bit below the longer-term average for the U.S. economy. Some of the higher frequency or monthly economic data points have been mixed, with as many showing more positive outcomes as those showing more negative outcomes. And that's leading to some of this volatility inter-quarter that we see in the markets. On the jobs front, job creation and absorption are at good levels. We have good nominal wage growth, although those growth rates are slowing. With inflation dropping, real wage growth has outpaced nominal wage growth on a percentage basis. And that leads to a more confident, more empowered spending consumer, which is good for the economy. GDP forecast for the quarter range between 2 and 2.75%. For the year, just under 2%, depending on which forecast you rely most on. Not great, but not bad. Inflation. On the goods front, since COVID, goods prices have come tumbling back down to earth. And looking forward, productivity gains, China being back on the map with oversupply should help keep a lid on goods-based inflation. Services, on the other hand, a different story, a bit more stubborn, creating some more bumps in the road. And the price levels that we have in the economy right now, one would expect them to remain with us for a while. And we almost have to grow into those price levels, much like a toddler grows into the next size up pair of pants that mom and dad buy them at the store. Productivity, previously mentioned, whether old school or AI based, offsets wages and material price gains, a positive impact on margins, and it's needed to meet or beat the earnings per share expectations that are in this market. On the monetary policy front, we still have a policy rate cushion where the Fed funds rate sits above the popular inflation measures, and that should keep a lid on future inflation. The most recent inflation data, I think I mentioned this last month, the last 3-month moving average of inflation rates annualized out for the last 2 months has been rising. Now, it's that last inflation number that really caught the attention of the markets. And it's pushed out expectations for a rate cut to later in the summer or early fall. Now, remember, this is an election year. So we might have a window of July, August for the Fed to make a move and not be considered political. But then your next stop is December and then the first quarter of next year, still within the range of 3 to 5 rate cuts in the next 12 months, but probably 2 this year and 1 or 2 in the first quarter of 2025. A little bit of history. The 8-month hold that this Fed has had on higher rates is not that unusual. Ben Bernanke's Fed in 2006, 2007 held rates high for 15 months. And hecklers exist today, about Fed action or inaction, and as well as they did in the 70s. And it was then that the Fed really fumbled the ball. They cut rates too early, too far, and held rates low for too long, allowing inflation to rear its ugly head again. And we had that ensuing battle in the early 80s that drove a lot of people crazy, for those that have been around to remember the early 80s in the marketplace. This Fed is viewing the inflation as a self-resolving, now resolved supply-side shock with no need to induce a recession. So higher for longer may just be the medicine needed to avoid deja vu. I'd give them a fairly wide berth because to date, my opinion, they've done a fairly good job managing the monetary policy of the US. Valuations, price earnings levels in the markets came in a little bit over the last week based on that higher than expected annualized inflation number, but still remain elevated. They're standing on the expectations of double-digit earnings per share gains, expected earnings per share gains for the next 2 years. I believe the number is 10.5% for 2024 and a shade over 14% earnings per share growth for 2025. Good numbers. Prices. Stock prices declined a bit in the last week or so, with price declines more so in the mid and small cap space than the large cap space. But the S&P 500 remains above its long-term support level and above the upper band of its more recent uptrend range of trading. Bond yields. With the more recent hotter than expected inflation data, interest rates in the 10-year Treasury yield rose from about 4.35, 4.36 to about 4.6%. Corporate spreads over Treasuries continued to narrow, and all else being equal on a forward look, I would expect interest rates to stay right around these levels unless we get a shockingly high inflation number in the next 2 reads, which is not expected, but got to make that comment. The yield curve, the expectations remain for the yield curve to normalize going forward. When exactly that normalization will occur? Well, I think it's about the same time frame, because with higher 10-year Treasury rates coming to a normalized yield curve where short-term rates are below long-term rates becomes a bit easier with a higher 10-year yield number. And when that happens, expect the significance of the yield curve normalization to be almost equal to the significance of a yield curve inversion. Only this time it will be felt in current income, as those that have crowded into the short-term maturity space see income rates falling, just like those that crowded into the longer end of the curve trying to squeeze more yield out of their bond investments felt their principal go down as rates rose. Short-term bonds are in their prime for now, with interest rates being well above longer-term rates, but the question remains for how long. Thank you for your time, and tune in next month for another edition of Econ Updates. Thank you.